Paul always suspected King Crab was more of a title than a name. And he wants to be the first human to bend the claw. Because one day, the crustaceans will rise, and only Paul will be spared. Foresight's a wonderful thing. Invest in innovation, including 3D printing, with Opto.
You've got 3 funds in this space at the moment: Tema Oncology ETF, the Obesity and Cardiometabolic ETF, and the Tema Neuroscience and Mental Health ETF, ticker MNTL. So perhaps you can explain why you chose those specific niches within the overall life sciences sector.
Yeah, so I think it's probably helpful to go back in time and think about kind of what biotechnology investing looked like in the 1990s.
Yeah.
When the NBI, which is the NASDAQ Biotech Index, was first introduced, it just had 100 members.
Yeah.
And the space was much, much smaller than it is today, both in terms of market size, number of companies, and number of treatments. I mean, in the early 2000s, there was probably only about 4 different treatments for breast cancer. If you fast forward to today, you've got 225 companies in NBI. You have almost 3,300 companies within the GICS healthcare sector. And then you've got 26, fortunately, effective treatments for breast cancer. And so you've had this explosion and growth in the space, which is why you've seen that share price performance as well of the sector. And that means that you can start to be more discerning about the areas. You can, for the first time ever, really start to dissect by therapeutic area. And you might ask why you do that. Well, investing in a broader biotech or healthcare sector fund probably exposes you to kind of basically a passive investment. There's a lot of other stuff in there.
Yeah.
And if you start to think about, if I dissect by therapeutic area, I can, one, expose to growing big markets and areas where there's lots of innovation. So if you think about obesity within our Obesity and Cardiometabolic Fund, HRTS, that's one area that's seen a lot of interest, but also oncology and mental health as well. You're also looking for what I would say is like exposure to good companies, right? Like you exclude companies that are, as I said, intermediaries or focusing on areas that are less pertinent to an investor who wants exposure to this space.
Yeah.
And the other thing is, by going down the vertical of therapeutic area, you're basically allowing yourself an ability to invest in adjacent bits, right? So if you take oncology, you could also be investing in diagnostics.
Yeah.
I know we talked previously that oncology is really a disease of aging. But in fact, there's been a really worrying trend that a lot of younger people are getting certain types of cancer. Right. Most prominently in this country, in the UK, we've seen a really tragic kind of in a really prominent figure, which is the Duchess of Cambridge. And there you need diagnostics to catch this early.
Yeah.
And the diagnostics can be quite invasive. And so the idea is, can we come up with a blood test that can test for cancer?
Right.
And so that's a key area that's part of our oncology fund as well. So you can go into this adjacency and then get exposure to these exciting bits of innovation. Similarly, if you take the cardiometabolic space, medical devices is a really important treatment intervention in that space. So can we add that to the fund? If you were going cross biotech, you wouldn't be able to do that because that's not really a biotechnology investment. And so we've decided to kind of dissect by these therapeutic areas to expose to growth, large markets, but also these adjacent parts. And we think now is probably the first time you can actually do that in what are really potentially very large markets for these types of funds. And that's why we've decided to go down this route of 3 types of therapeutic areas.
And once you pick those therapeutic areas, there's subsegments within those that you've already kind of mentioned and pointed out some of those. When you're thinking about the fund construction and portfolio construction, do you think about diversifying across different subsegments within that area, or is it more kind of bottom-up stock picking and then you're led by that?
Yeah, I think that's a great question. I think we are bottom-up stock pickers, but we are very cognizant of what the portfolio looks like afterwards.
Yeah.
So we dissect the portfolio in many, many different ways. But one of the ways we look at it is we try to think about, okay, what is the mix of emerging biotechnology companies, the ones that are pre-revenue, growing biotechnology companies and life science tools or medical devices where they have revenue lines already, and then more established players as well. And then we generally try to keep that, the end result, a balanced portfolio between those kind of risk buckets, if you will. And as I said previously, also our position sizing, it is different depending on the type of company. And then based on technology, we try not to take overexposed risks in specific technology areas. So whether it's, RNAi or gene editing or intervention through targeted oncology or ADCs, we try to make sure that we're not taking too much of a technology bet, because what you want is a bit of a broader profile. But a lot of that does come up from the bottom up rather than sort of directed top down. So that's how the funds are constructed themselves. And it gives the investors the best chance to win in this space in an active format.
And so once those themes have been identified, we talked about the sub-themes as well. If we get down to the individual equity level, what are the key sort of fundamentals, and maybe there are more kind of qualitative characteristics that typically apply to the companies that end up in your portfolios? Are there any sort of trends you can highlight?
Yeah, so we follow quite a rigorous kind of investment process. I think what's very clear about active management is that active managers add a lot of value in just the stock selection process. And it's really the bread and butter of what we're trying to do. And this is entirely fundamental, bottom-up research that we do, led by David and his team, and a real focus on picking the best companies. And in general, the best way to classify it is kind of we use 4 pillars to analyze each company. The first is operating base, which we discussed before. Do they have the right R&D platform, the right management team, the right business model that they're going after? The second bit is, do they have the right funding profile, cash flow generation, if they have assets on the market already? Those two together are really important. We need to tick on both of those to really make sure that we're protecting on downside risk. And this is really important because, as I said, you're in the right zip code in terms of therapeutic area. Now the question is, are you going to fumble that growth and fumble that exposure? And you can only fumble that. You basically protect yourself by having those two as ticks. The other two parts of the test are really evaluation. Can we build a valuation case? And what's our edge? Like what's our advantage in the market versus what the market might think about the stock? And here it's kind of combined together in this asymmetric risk reward opportunities, which is what we're looking for. And so if you bring all of those together, each investment has to meet these 4 pillars before it joins the portfolio. And that's probably the best way to classify or describe the security selection process.
Yeah, just to dig into that, perhaps you can give us an example of an edge, just to make it a little bit less abstract. What would be an example of edge kind of actually manifesting in a company? Yeah,
it's great. And again, you can head up to our website. We actually have written recently an article about all of these different parts of our investment process, including how we think about edge. But look, I think it starts by saying you're actually asking that question. And I think a lot of fund managers never ask that question. They sort of make investments and they don't think, okay, I need to beat the market, and the market has an assumption about these companies. And so by explicitly incorporating in our investment process, we're trying to just ask that hard question. And I think it starts with that. That already itself is an edge. And then in terms of edge, generally it's classical, there's different ideas, but it can be either informational, behavioral, analytical. And I think a lot of the times within biotech investing, it's really analytical edge. What you're trying to do is set up these asymmetric risk reward opportunities where you say, okay, this is a clinical trial readout. I'm not going to try to call this trial, but what's actually priced into these shares? What does the market think this particular thing is? And then we go out and get evidence to suggest whether our asymmetric risk reward we're stacked in the right way. And so there's plenty of examples where we've had calls with key opinion leaders that have basically made us trim or cut positions ahead of events to try, because we felt the risk reward wasn't right going into those events. And it's this kind of active management that adds value for these funds over the long run. And that's a source of analytical edge, using an expert network to ascertain that advantage. And we have David's come up with some very clever ways of using expert networks and expert opinion, because often it can be a little bit biased, or there's lots of different individuals and they might have different views, that I think is extremely clever in the marketplace and really gives us this edge when investing in these binary events.
Yeah, fantastic. And just overall then, I assume given the nature of the space, you're employing a long-term investment horizon when you're thinking about these and the management of the fund. But talk to us about how you balance that more active portfolio management style with that longer term horizon.
Yeah, I think we're very much long term. And I think David's experience is perfect here. It combines 2 parts. He spent a long time working for Rockefeller Capital Management, where he ran a healthcare fund over a decade. And then at the same time, he's had some stints at Millennium and Balyasny. And I think those two areas are well-known hedge funds that are a lot more short-term.
Yeah.
And I think the biotech sector is basically that. You need a combination of long-term vision and understanding where trends are going, the rise of weight loss drugs and the obesity trend, and how to invest long-term, but also to be tactical and understand that the sector is prone to bouts of risk on, risk off. The sector is binary clinical events. And so you have to be able to manage those risks in the medium term before you get to the sunny uplands of the long-term trend. And that, I think, is the best way to describe how the investment process is. We're in innovative breakthrough companies, but we're not sort of just blindly investing in a passive way. We're trying to manage those risks through that so that we can get exposure to the winners of tomorrow.
Yeah, fantastic. And to finish on these funds then, perhaps you can just talk us through the performance of each one, maybe over the last 12 months or pick a time horizon that makes sense. And perhaps as well highlight which of those is the top performer, and if you can also give us a sense of the key tailwinds bolstering growth for each of those.
Absolutely. I have to be a little bit careful here about talking about performance, so I should probably say that if you want to get the most up-to-date performance, you can head to the Tema ETFs, TEMA ETFs.com website and get the latest fact sheets and the latest performance numbers. I think since inception, all funds are well ahead of their benchmark, which is the Nasdaq Biotech Index, and which is great, and we're really pleased with that performance. And I think there's been several tailwinds that have helped the funds. I think within the oncology space, there's been quite a lot of M&A that's happened. This is a sign of why we think the market is healing after this period of undervaluation. Large biopharma companies are running up against patent cliffs for some of their biggest medicines, and they need to replace them. And a lot of the innovation happens in smaller biotechnology companies, and what they're doing is buying these up. And our oncology fund has been, very fortunate to be exposed in reasonable size to some of these M&A transactions that have happened, and we've had a very good hit rate there. And so I think that's been a nice tailwind, and it's generally a tailwind for the sector because that money goes in, these companies get bought, but then the money returns to biotech investors who then have to reinvest in other areas and new ideas. So it's a driver of return over the long run. And so I think that's been a driver there, but also innovation has been a really big thing. And the reason why that innovation has been really powerful in oncology is it's happening in areas where we're trying to replace something that is a very big market. So let me give you an example. Antibody drug conjugates, ADCs, are effectively a really clever way of chemotherapy. So the idea is you take an antibody that targets a cancer cell and then you attach to it using a linker, a toxic chemical. Now, we all know that chemotherapy is just a toxic chemical and it has terrible side effects, killing healthy cells and healthy tissue. But what if I can attach it to an antibody that can target actual cancer cells so that it delivers the toxic payload just to cancer cells? And so we know that loads of patients, I think the number is like 37%, still get chemotherapy today. So it's a vast, vast market. And if we can develop these linkers and these drugs, and some of them are already on the market, this could be potentially a very, very large oncology market. And now we're seeing loads of M&A in that space as well. And so that is kind of exposing yourself to the right area where the technology is ripe and the strategic buyers are coming in is a real driver of return for that fund. If I look at our best performing fund, which has been the Cardiometabolic and Obesity Fund, that fund is just benefited from, I think, interest in the space, but a realization that the market is going to be a lot bigger than anyone thought. And the reason for that is obesity is, first of all, a very, very large market. The latest estimate from the Imperial study is about 1 billion people in the world live with obesity. And that number might go up to about 1.9 billion in a decade's time. So it's a real epidemic. And we also know obesity is associated with about 220 different diseases, from diabetes to cardiovascular disease to liver disease. And what's really happening is a revolution. These GLP-1 drugs are now showing clinical data, positive effects on cardiovascular outcomes, on liver disease, on kidney disease, on sleep apnea. And as we prove out more and more of this, the market was just going to grow. And I think that's what's being reflected. And not just the share prices of the bellwethers like Eli Lilly and Novo Nordisk, but some of the newer crop of companies that are coming up that the fund is invested in. And that's why we've seen that good performance. And finally, MNTL, which is one of the newest addition to our fund. Yep. Look, I think it's super exciting, right? And this is a very catalyst-rich future for it. The fund has recently launched, so I think the catalysts are ahead of it. It's really difficult. Neuroscience is the final frontier of medicine. And I think we all know how hard it is to understand how the brain's chemistry works.
Yeah.
And the innovation's coming. As I said, we've got a disease-modifying agent for the first time in Alzheimer's. So we think that there's just going to be this big burst of innovation. And this is the biggest market of all, because the latest estimates is about 43% of the world's population has some sort of mental or neurological disorder.
Wow.
Whether it's Alzheimer's or depression or schizophrenia or whatever it might be, it's enormous. And what's really interesting about mental health is it has very deep effects on just well-being and quality of life and productivity. And if we can start to solve some of those problems, that could be a real revolution as well. And so that is, I think there's a lot of positive future return drivers for that fund in the future as our newest crop, as our newest member of the crop.